David, how are you?
Doing great. How are you?
Awesome, awesome. Thanks for taking a few minutes to hang out with me. And this was spurred by the conferences. I've been to a few of the Jeffries conferences that you spoke at, and just always loved hearing what you had to say about what was going on in the world around us and the U.S. economy and whatnot. For many of us in tech, I'm sure as we're heads down, building products, investing in companies, and in particular, right now, so much of what's going on is macro. And I think it's causing a lot of conversations that aren't common in our universe among founders and investors. And I just thought it'd be fun to have you on and ask you a few questions and pick your brain a little bit if you're up for it.
Let's do it.
Can you give folks a little bit of your background, sort of how you got to where you are and what you're doing today?
Sure. I was an engineer, probably, headed into some sort of techie world at some point at WashU in St. Louis, systems and electrical engineering. Got kind of hooked into economics to raise my GPA. They told me if I went over to the economics department, I could. And turned out I really liked the class. There was a professor named Doug North who actually won the Nobel Prize a few years before his passing. And he was an economic historian. And I just loved the history side of economics and the repetition of industrial cycles and innovation and understanding incentives and property rights and everything else that he taught us. And he just hooked me. And so I decided, instead of going to work for Rockwell or McDonnell Douglas or any other companies that everybody was going to work for, I'd go do a PhD in economics at the University of Rochester. And I did that and got really into it, and came out and went, thought I would be a professor, publish economic papers, which I did for a little while, and went to the Board of Governors of the Federal Reserve System as an economist after grad school, got into my publishing gig, and ended up meeting some people at the Bank of England that were in the markets. And they said, hey, you want 5 times your salary and you want to come move to the and be in financial markets? And I was like, hey, this sounds pretty good. Let's do it. And, my wife at the time was very amenable. And that was, a long time ago, close to 30 years ago. So 28 years ago now. So it's been a pretty fun run. I've been at Swiss Bank Corporation, which was SBC Warburg. I've been at Greenwich Capital Markets. I've been at UBS O'Connor. I worked for a couple of different hedge funds, including Brevin Howard. And I've been at Jeffries 13 years. So this is my longest stint. I love the research side. I was a trader for 7 years, just managing global macro money. And I kind of decided I just really liked writing. I really liked, I kind of get back to my roots of teaching. I love the idea of discourse in an academic setting, but I also like having it have real world implications. And this job has given me the ability to be kind of more of a writer and a speaker. And so I get a little bit of my academic side, but I gotta be right on markets more often than not. Otherwise, guys like you aren't going to listen. And I love macro. It's the greatest puzzle out there. There's no solution. It's not engineering. There's no science. It's art. And it's thankfully, I shouldn't say thankfully, but in the last 15 years since the global financial crisis, macro has touched everybody, including, as you said, you guys with your heads down, on the ground level. I'm coming at 50,000 feet looking at the world. But I think, every once in a while you look up and go, wait a minute, some crazy stuff's happening up there. I got to figure it out. And we're in one of those moments now.
I was going to ask, are we in one of those moments?
It's fun. I'm actually, to be honest, I usually spend about 20% of my time with banking clients and corporate clients. It's usually fixed income equity clients that are, real money managers, hedge funds, insurance companies, banks, mortgage companies, guys that are really doing, trading in financial markets and active. And this year, I'd say, almost half of what I'm doing is talking to our banking clients, our corporate clients, about the macro environment, because it's just such a confusing time, and it's a time where really having impact. So I find it fun. I mean, I did that a lot in the beginning at Jeffries in 2009, 10, and 11, and then there were a few times during the Euro crisis that happened as well. And obviously when COVID hit, that was a big deal. And now again, here we are. So
Well, I'm glad to hear you say it's more art than science, because for those of us who've been trying to sort it out over the last 12 to 18 months, it's been tough, and in particular for founders and CEOs who just don't spend time on these topics. So, on that note, maybe could you help give folks a little bit of understanding of sort of like how we got to where we are? Like, I think a lot of people want to know, like, where are we? Like, what the hell is going on? But like, there's also been a lead up, a several year lead up to get here. Could you just sort of give us a little bit of context? What happened over the last, I don't know, 3 to 5 years, whatever time period has really led us to where we are today? And then we'll talk a little about where we are today.
So I think to really understand it, and I know we have a limited amount of time, I want to go quick, but not so quick that we don't get value out of it. I think you really have to go back to the global financial crisis to understand how we got here. Because in the global, you took this guy, Ben Bernanke, who was a real academic, kind of a doctor of sorts, a doctor of this art, maybe a dark art. And he sort of got in the room and he said, okay, I've studied the Great Depression. I know what happens when an economy has a lot of debt and it goes into a deflationary spiral. It's really bad. And we're not going to let that happen. And he basically made a bet. He said, look, I'm going to go and print money, and I'm going to print a lot of it. And if I end up in the 70s, that'll suck, but I'll take that over the 30s. And I hope that by doing this, I'm going to spur people like yourself to go out and stop hoarding dollars, stop staying in T-bills. And because there's all this money getting printed, go out and be innovators. Go out and actually take real risk, because the cost of sitting in cash when they're printing a lot of cash is very high. They're diluting. So you created this incentive from the central bank to go out and be innovative. And we saw a lot of innovation. We saw the gas revolution. We saw a lot of biotech innovation. We saw a lot of these low real rates, and this higher inflation expectation came into the market, kind of give us a recovery. And slowly but surely after 2009, we got there. And I think in retrospect, if you asked all those central bankers, if they had to do it all over again, what would you do differently? They all said the same thing, and they had a big conference in 2019 and said the same thing. We go bigger and we go earlier. We just do more and we do it faster, because they kind of did QE1, QE2, QE3, QE infinity, Operation. They had all these different things, but in the end, we never got any inflation. And so their constraint was, with all this printing, where's the inflation? They never got it. So when COVID hit in 2020, they felt very emboldened to go big and go early, and they did. What we did in 2020 was epic. And the balance sheet, which was a $4 trillion balance sheet, let's say, at the beginning of COVID, very quickly went to an $8 trillion balance sheet. We even more, almost 9 in the end. We over doubled it. And if you look at the process of what we did during QE1, 2, 3, and 4, or QE1, 2, 3, and QE infinity, we did these little increments of $1 trillion, $1 trillion, $1 trillion. And we got from basically 1 to 4 over the course of, 4 years, 5 years. So they went big, they went early. Now, the debate among economists today is, was that what the Fed did responsible for this inflation that we're seeing today, which is generationally high inflation, or coming from these adverse supply chain shocks that would have hit no matter what the Fed did? The zero COVID policy in China, the war in Ukraine, and even before that, as we were in Q4 last year, just the restarting of an economy that was globally that was shut down. It's very easy to turn your factory off and say, okay, everybody go home. And then a year later, you walk in, you flip the lights on, turn the keys, and hey, that part's missing. This thing isn't working. Over here, moved to Montana. The other guy moved to Miami. You can't put it together that fast. So the debate is really raging. I don't, we could debate that all day. I think in the end, though, it doesn't matter whether you believe the Fed was heavily responsible for it or not. Their job is price stability. And the reality is prices aren't stable. We have high inflation. And the risk is that high inflation manifests itself into longer term expectations about high inflation. And thank goodness today, the Fed has not fallen into any major credibility problems, even though you hear a lot about that on the news and from a lot of pundits. But they have to be sure they don't fall into that, because the worst thing that can happen for you and your friends in the tech business is that you have to start to worry about inflation over 10 years.
Yeah.
That all of a sudden it's not 2% anymore, it might be 5 or 10. And that totally changes the way you discount future cash flows. And the way, and it's not just about the number that it is. If you knew with certainty what it was, you could make decisions. But the fact that it could be either 2 or 10 really changes everything about your investment decision, and it curtails entrepreneurial behavior. It curtails growth. It is the worst thing that can happen to the US economy. Jay Powell knows it, the Fed knows it, the economics profession understands it, and that's why they want price stability. So right now, what are we doing? How did we get here? We got to a Fed that is saying, you know what? You got to take the medicine. You got to bring this inflation down. You've got to make sure these inflation expectations do not get out of hand. We gave you a lot of painkillers when there was a lot of pain. The labor market's in great shape. We're going to take the painkillers away. It's going to hurt. You're going to have to take it. And we're going to have to even do a little bit more because this inflation story has manifested itself, and we cannot afford to let what we call negative supply shocks in economics turn into something that destroys the inflation fighting credibility of the Fed that they've built up since Paul Volcker 40 years ago. That's where we are. So that might have been a little long-winded, but I think it was.
No, it's great. Actually, it's great context. Yeah, it's great context. And so I think what folks are struggling with today, and maybe you kind of explained it there, but the correlation between the Fed responding to inflation, raising interest rates, why can you walk folks through just at a very simple level? Why does that bring down valuations for technology companies? Did you catch me there?
Look, at the end of the day, look, we're all looking at taking risk and what the reward is for taking that risk. When the Fed wants to spur risk taking, it takes the risk-free real rate lower. It says, you know what? The economy's weak. There's not a lot of job creation. We're going to drive rates lower. And they drive nominal rates lower. And sometimes they get to zero, like they did last time. And then they try to make inflation expectations go up because we have a few equations in economics. There's not many. MV equals PQ, which is the original Fisher equation. We shouldn't overplay equations in economics. It's not a science. So please never go there. But if we raise inflation expectations or lower rates, we take real rates down. That means if I'm sitting in dollars, I'm getting a negative rate. I'm gonna basically put my dollars in the bank. After inflation, I'm gonna get back basically less real dollars. I'm gonna get less bread, wine, cheese, whatever you want to measure in real terms. So when the Fed wants to slow things down, it raises those real rates. And it says, you know what? I'm going to pay you to just sit in cash for a little while. I'm going to give you 2% in real terms after inflation. And that's going to curtail activity and risk taking, because at the end of the day, if I can make 2 or 3% after inflation, I'm going to take a lot less risk than if I'm going to lose 4% after inflation, which is sort of where we were, say, in 2011. And so that's the Fed's game. So that's why it it also affects cash flows in technology a lot differently than cash flows in value, because to the extent that your cash flows from the expectation of success in your business are further out, as discount more, as there's more uncertainty in inflation, you discount your cash flows more. It's not even about the expectation of where rates will be. It's that there's more uncertainty about rates being. And so I'm less inclined to put my money in something that has a cash flow 10 years out, and I'll bring it back to something that has more certainty 2 years out. So it's really a double whammy.
Well, I know that was kind of a basic question, but it's the thing that a lot of people are trying to figure out right now, people who are not economists or macroeconomists, is why is all of this putting a damper on valuation? Because for a lot of people in tech, they're still seeing a ton of demand. Customers are buying. The markets are as big as they've ever been, if not getting bigger. But it's all these factors that you're talking about capital seeking less risk and discounting future value. So I guess the question there is, where do we go from here? What is the Fed doing now? And what happens over the next 6 to 12 months if it works, quote unquote?
Look, there's a couple of things that I think are really interesting, kind of theoretically on the tech side, that I thought I'd share with you.
Yeah.
One is, when the Fed is lowering rates and when there's a lot less inflation, and actually we have more deflation problems than inflation problems like we've had in the last few years, we do find that the central bank is setting up policies that really do favor, spurring innovation, spurring creativity, spurring growth. They're incentivizing that. When they're fighting inflation, they're disincentivizing that, and that's a problem. And one of the things we know is that technology itself is a very disinflationary thing. The more we have of it, the more we get these longer term trends that are disinflationary, whether it's, TV prices or communication or transportation or anything. Mm-hmm. This disruption is doing is it's creating better value propositions for the end consumer. And it's creatively destroying old technologies and old businesses. And that generally is disinflationary. So if the Fed has to fight disinflation, we might get a temporary period where technology isn't being as disinflationary as it has in the past. So it's got an unfortunate convexity to it that's not pleasant from the inflation fighting side. So I worry a little bit about that. Mm-hmm. Say that, I've spent 2 parts of my career working at the Fed. I told you in the beginning, I was an economist in the early 90s after grad school, but I didn't tell you that in 2009, I left Wall Street and I went to be an advisor to the Board of Governors in DC to advise them on many of the programs that they were building to respond to the global financial crisis, the TALF, the TARP, the CPFF, whatever FF we could come up with. And my experience, I'd say with those folks, look, they're not business people, they're politicians and they're government employees. They're generally pretty good-natured people, generally pretty benevolent people. There is a lot of politics at the top, but I don't think there's a lot of reason right now to believe that this Fed has lost control of the situation. I think they very much are in control, and that the market is rewarding them with lower long-term interest rates and lower break-even expectations. And that is important. To the extent that the long end of the yield curve stays in and around this 3 to 3.5% region and possibly goes lower, the curve stays inverted, gold stays low, the dollar stays strong, you know what? You guys don't have a lot to worry about.
So I guess your key point there, though, is watch the long duration assets. And as long as they remain, they're not spiking, then the Fed's got things under control.
Very important for you guys. Yes.
Yeah.
I will say there's one caveat that you should watch in the next short term. And this is not a long-term issue, but the Fed does want to reduce its balance sheet. As I told you, they added $5 trillion to their balance sheet very quickly. I think they see that as something they'd like to get down sooner. To the extent that long rates are staying low, they may opt for less rate rises in the front end, and they may try to accelerate the balance sheet unwind. And I don't want to, again, get too technical with all the, QT and all the issues around mortgages and treasuries on the balance sheet. But there is a risk, and I think there's a material risk, that they will let some of this duration go faster in the next 18 months. So there could be another, we're going to have a couple of wobbles. This is not, I don't see a quick run up back to the highs in equities. I think we're going to struggle a little bit. My strategy all year has been selling covered calls, and I'm sticking with that. And I just think the downside risks are there. I don't think we have a crash. I think there's a few reasons why we could talk about that, but I think we're going to struggle to really have material rallies anywhere near where we got to pre this tightening cycle. The Fed has a lot of reason to try to make this inflation go away and go away faster. And the more the economy strengthens and the more equity markets are strong, the more they're going to feel emboldened to do that.
Mm-hmm. And that gives time for Russia, Ukraine to work itself out, China to work itself out. Some of these other broader issues that are outside of our control maybe are also friendly to that longer time horizon.
I think that's fair. Yes.
Yeah.
And look, I think, you've got a great situation with our labor market. It's unbelievable how strong it is. The job openings went back up this week. We saw jobs up above 11 million. And typically in the best of times, there's 7 million job openings in the best of times. So we have an incredibly strong labor market. And there's a variety of technical reasons why maybe it's not as strong as some of the data suggests, but we'll weaken it. It'll start to weaken. The Fed's going to knock it down a little bit. There's no question. But we could afford to lose 4 million help wanted signs before we even fire anybody. So, and get back to 7 million job openings. So I'm pretty optimistic that we're not in a situation where we need to have a major market correction, either due to multiples and long rates going up or earnings. And if you give me a little bit of time here,
Yeah.
Earnings are a very important key to this. And why do I say that? This year, we are growing at a negative real rate, right? We have real GDP contracting by about 1% in the first 6 months of the year on an annualized basis. Nominally, we are growing at close to 8% because we've got 8 to 9% inflation run rate. So when you have nominal growth is nominal income. It's how much income, how much expenditure, and how much income. Nominal expenditures and nominal income grew at 8% run rate in the first 6 months. Last year, they were at 12%.
Yeah.
In every other year before this, we were like 4.
Yeah.
2 inflation.
On a good year. Yeah.
1, 3 inflation. 3 real, 1 inflation. For decades, we tripled nominal growth. And now we're still. Earnings are a nominal variable. They're just dollars. They're not real. They're not adjusted for inflation. You don't adjust your earnings for inflation. You just earn. There's more earnings when there's more income, when there's more expenditure. So to me, this whole concept of a major earnings collapse is really hard to buy into. And I was very, surprised to see how many people this past quarter were predicting these cataclysmic earnings numbers. And the reality was, it's like, you know what? There's a lot of dollars sloshing around in this economy. In fact, we're growing at 8% nominally. Now, we're spinning our wheels when adjusted for inflation, and that kind of stinks. That is recessionary from an economic standpoint. But you know what? Your stock price trades at a nominal dollar, doesn't trade as a real dollar. S&P trades in nominal terms. Oil, gold, real estate. These are all denominated in dollars. So at the end of the day, they're also all hedges for inflation. If I own Caterpillar stock, I own bulldozers. I'd rather have bulldozers when there's inflation than a couple pieces of paper with George Washington on them.
Yeah.
And I'd real estate, and I'd rather have commodities. So I think you have to step back and understand this is a very interesting regime. It's a regime where nominal growth is high, real growth is really low. And that's an environment where, and inflation is high, but inflation expectations in the future are low. It's actually an environment where anybody that's running a leveraged balance sheet is seeing their assets generally rise in value in nominal terms and their debts getting devalued as long as they have termed them out, and their balance sheet in kind of real terms looking quite a bit better. So I'm very optimistic that we don't have to go down to kind of 3,000 in the S&P and really blow everything up. I think the last low was an interesting one. Could we get there again? Sure. Should we be at 3,600? I don't have any problem with that. I think that's a time where you get very interested again.
To me, it felt like the May-June timeframe was sort of peak fear. People really had a fear that we didn't understand Russia-Ukraine. The Fed didn't have its act together in terms of raising rates. And they felt like, at least folks I was talking to, felt like it was going to get out of control and we were going to really have to slam on the brakes. And it sounds like since then, sentiment has shifted more towards we actually can figure this out. It's just going to take some time.
Is that coincided with the Fed going 75 basis points, middle of June, going 75 basis points again. Jay talking tough. Jay saying, I care about inflation. Not let the 70s come back. Okay. You guys are going to have to take some short-term pain. I'm going to punch you in the face a few times. You're going to get a bit bloodied up, but guess what? You're going to come out of the other side of this ready to rumble with a strong economy, anchored inflation expectations, and you're going to be stronger than ever. I know we have a limited amount of time.
No, it's great. I love it. That's a great quote.
a kind of last metaphor, if you will. So in my PhD thesis, I did a lot of writing about addiction, models of addiction, and rational addiction and why people get addicted. And we started building models at the Fed about central banks getting addicted to inflation and how they can fall into the trap. And they were fun papers. But if you think about QE and what it is and what we created, what Ben Bernanke created in that laboratory back in 2008, it's really a drug. It's a painkiller.
Mm-hmm.
And it killed a lot of pain. And it was really a wonderful thing. And it turned out that we didn't suffer a lot of the negative consequences from QE that many people thought we might. It didn't have the same side effects that everybody was warning. Many economists, John Taylor out by you in Stanford, Neil Ferguson also out by you in Stanford, all these guys signed a Wall Street Journal full editorial page in 2011 saying we should never do QE2 because it's going to turn us into Zimbabwe. Well, guess what? Didn't happen. The reality is that it still is a very potent drug.
Yeah.
And we took a lot of it in 2020. And maybe it did have some impact on this inflation outcome. Maybe, maybe not. We can debate it. But right now, we have inflation. We have a side effect that we need to get rid of. And QT is the withdrawal of that drug. We are going into withdrawals. This is what it feels like. It's a bit of convulsion. It's a bit of unpleasantness. But we're going to come out unaddicted, better, stronger, faster than ever. And we're going to use those painkillers again in the future when we need them and know that we have a doctor that can both put us on them when we need them and take us off them when we don't need them. And we don't have to worry about getting into the bad side of it, the sort of Zimbabwe, Turkey, Argentina side of it, where you get hooked on this stuff and you can't get out of it. And I think part of why the market in June bottomed is that there was this weird feeling developing that the Fed was losing. Inflation was skyrocketing. We didn't really know what was happening. And people really did worry about an unanchoring of inflation expectations. And Jay acting like Paul Volcker, I think really put the bottom in the market. That's my feeling.
No, you felt it. I think uncertainty was high. People were really nervous. I think also the federal government wasn't saying anything particularly constructive. And I think people were very nervous about Russia, Ukraine, and what that was going to do to oil and food supplies. And it feels like that's, it's still a huge issue, but it's normalized a bit.
Yeah.
Well, this has been great, David. I appreciate it. Anything we didn't cover that we should?
In and chat with your podcast viewers. I'll be curious what feedback you have, and hit me up with some questions if you want. I'm happy to try to chase them down.
I will. People will love it. People will love it. I think it's always, like I said, we're out there grinding, building companies, hiring people, creating jobs. So your original point about the Fed and the government wanting that and tech being deflationary, which I think it is so important. But people just don't have time to jump up to 50,000 feet and understand it all. So you do an incredible job of breaking it down, and I appreciate it.
Well, thanks very much for that. Have a great rest of the day in San Fran, and I'm going to enjoy the rest of the limited evening that I have here in Italy.
All right, man. Thanks. Appreciate it.
Take care.